Good morning, everyone. Welcome everyone to this video fourth that is all about financial planning and sources of finance. Let's start with the meaning of financial planning. Finance is an important function of business. The application of planning to this function is a financial planning. This function is mainly concerned with the economical procurement and profitable use of funds. It involves determination of objectives, policies, procedures related to finance function. Financial policy and procedures are the broad guides in the procurement, administration, disbursement of funds. Financial planning is an important function of a finance manager. Whether the business is big or small, this function has to be performed. Similarly, an existing as well as new business have to plan this function with great care. A well-prepared financial plan will not only ensure the procurement of sufficient funds, but their proper utilization also. At the time of promoting a company, this function is performed by promoter but later on assigned to the finance manager. A financial plan should be formulated in the light of the present as well as future developments. The requirement for purchasing the fixed assets and working capital need should be first estimated. The need for the funds in the future for financing expansion and diversification should also be taken into consideration. A decision about the type of securities to be issued is also an important aspect of financial planning. The amount of capital to be issued, the type of loan to be raised, the cost of raising funds from different sources should be carefully decided. According to Robin, financial planning should first determine the financial resources required to meet the company operating program. Second, forecast the extent to which these requirements will be met by internal generation of funds and the extent to which they will be met from external sources. Third, develop the best plan to obtain the required external funds. Fourth, establish and maintain a system of financial control governing the allocation and use of funds. Formulate programs to provide the most effective profit volume cost relationships. Analyze the financial results of the operations. Report facts to the top management and make recommendations on future operations of the firm. Next topic is financial plan. A financial plan is a statement estimating the amount of capital and determining its composition. The quantum of funds needed will depend upon the asset requirement of the business. The time at which funds will be needed should be carefully decided so that finances are raised at a time when these are needed. The next aspect of financial plan is to determine the pattern of financing. There are number of ways for raising the funds. The selection of various securities should be done carefully. The funds may be raised by issuing of capital and debentures and raising of loans. While the source of finance should be raised and up to what amount these should be raised is very important. Once a pattern of financing is selected, then it becomes very difficult to modify it. A financial plan also spells out the policies to be pursued for the flotation of various corporate securities, particularly regarding the time of their flotation. Next, objectives of financial plan. First one, a financial plan would ensure availability of sufficient funds to achieve the enterprise goals. Second, there should be a balancing of cost and risk so as to protect the investor. Third, a financial plan should ensure flexibility so as to adjust as per the requirements. It should be adjustable as per the changing conditions. Fourth, the financial structure should not be complicated by issuing a variety of securities, and the number of securities should be less so that it is easily understood. A financial plan should take a long term view. The needs for funds in the near future and over longer periods should be considered while selecting the pattern of financing. The liquidity of the fund should always be kept in mind while preparing a financial plan. During the period of depression, it is the liquidity which can keep a concern going. A financial plan should ensure sufficient funds for normal needs. Neither the plan should suffer due to shortage of funds nor there should be wastage use of them. The fund should be put to their optimum use. Economy. The cost of raising the funds should be minimum. It should not impose disappropriate burden on company. It can be ensured by a proper debt equity mix. Next, I will talk about steps in financial planning. So, there are four steps in financial planning: establishing financial objectives, formulating financial policies, formulating procedures, formulating for flexibilities. Let us start with the very first step, that is establishing financial objectives. The financial objectives of a company should be clearly determined. Both short term and long term objectives should be carefully prepared. The main purpose of financial planning should be utilize financial resources in the best possible manner. There should be an optimum utilization of funds. The concern should take advantage of prevailing economic situations. Second step is formulating financial policies. The financial policies of a concern deal with the procurement, administration, and distribution of business funds in a best possible way. There should be clear cut plans of raising required funds and their possible uses. The current and future needs for funds should be considered while formulating the financial policies. Formulating procedures. The procedures are formed to ensure consistency of actions. The procedure follow the formulation of policy. If a policy is to raise short-term funds from bank, then a procedure should be laid down to approach the lender and the person authorized to initiate such actions. Fourth, providing for flexibility. The financial planning should ensure proper flexibility in objectives, policies, and procedures so as to adjust according to changing economic situations. The changing environment may offer new opportunities. The business should be able to make use of such situations for the benefit of the concern. A rigid financial planning will not let the business use new opportunities. Now let us discuss various limitations of financial planning. Some of the financial limitations of financial plannings are difficulty in forecasting, difficulty in change, problem of coordination, rapid change. So the first point is difficulty in forecasting. Financial plans are prepared by taking into account the expected situations in the future. Since the future is always uncertain, things may not happen as these are expected. So, the utility of financial planning is limited. The reliability of financial planning is uncertain and very much doubted. Difficulty in change. Once a financial plan is prepared, then it becomes difficult to change it. A changed situation may demand change in financial plan, but managerial personnel may not like it. Even otherwise, assets might have been purchased, raw material and labor cost might have been incurred. It becomes very difficult to change financial plan under such situations. Problem of coordination. Finance function is the most important of all the functions. Other functions influence a decision about the financial plan. While estimating the financial needs, production policy, personal requirement, marketing possibilities are all taken into account, Unless there is a proper coordination among all the functions, the preparation of financial plan become difficult. Often there is a lack of coordination among different functions. Even indecision among personnel disturb the process of financial planning. Last point, rapid changes. The growth mechanism of industry is bringing rapid changes in the industry process. The method of the production, marketing devices, consumer preferences create new demands every time. The incorporation of new changes require a change in the financial plan every time. Once the investments are made in the fixed assets, then these decisions cannot be reversed. It becomes very difficult to adjust the financial plan for incorporating fast changing situations. Unless a financial plan helps the adoption of new technology, its utility becomes limited. Next topic is sources of finance. In our present day economy, finance is defined as a provision of money at the time when it is required. Every enterprise, whether big, medium, or small, need finance to carry out its operations and to achieve its targets. In fact, finance is also indispensable today that it is rightly said that it is the lifeblood of an enterprise. Without adequate finance, no enterprise can possibly accomplish its objectives. Capital required for a business can be classified into two main categories, that is fixed capital and working capital. Every business need fund for two purposes, that is for establishment and to carry out its day-to-day activities. Long-term funds are required to create the production facilities through the purchase of fixed asset like plant and machinery, land and building, furniture. Investment in these assets represent that part of the firm's capital which is blocked on a permanent or fixed basis, and it is called as fixed capital. Funds are also needed for short-term purpose, for the purpose of raw material, payment of wages, and other day-to-day expenses. So these funds are called as working capital. So the various sources of raising the long-term funds include issue of shares, debentures, pulling back of profits, loans from the financial institutions. Short-term requirements of funds can be met from the commercial banks, trade credit, installment credit, advances, factoring, receivable credit, accruals, deferred incomes, and commercial papers. So let us start the various sources of finance. Under that, I'm starting the very first, equity shares. So equity shares are also called as ordinary shares, common shares, and it represents the owner's capital in a company. The holder of these shares are the real owners of the company. They have a control over the working of company. Equity shareholders are paid dividend after paying it to the preference shareholders. The rate of dividend on these shares depend upon the profits of the company. They may be paid a higher rate of dividend or they may not get anything. So these shareholders take more risk as compared to preference shareholders. Equity capital is paid after meeting all other claims, including that of preference shareholders. So they take risk both regarding dividend and return of capital. Equity share capital cannot be redeemed during the lifetime of the company. Second source of finance is preference capital. As the name suggests, these shares have certain preferences as compared to other type of shares. These shares are given two preferences. There is preference for payment of dividend. Whenever the company has distributable profits, the dividend is first paid on the preference share capital. Other shareholders are paid dividend only out of the remaining profits, if any. The second preference of these shares is the repayment of capital at the time of liquidation of company. After paying outside creditors, preference share capital is returned. Equity shareholders will be paid only when the preference share capital is returned in full. A fixed rate of dividend is paid on preference share capital. Preference shareholders do not have a voting right, so they have no say in the management of the company. However, they can vote if their own interests are affected. Those persons who want their money to fetch a constant rate of return, even if the earning is less, will prefer to purchase preference shares. So, under preference shares, some more subcategories are there. For example, we are having cumulative preference shares, non-cumulative preference shares, redeemable preference shares, irredeemable preference shares, participating preference shares, non-participating preference shares, convertible preference shares, non-convertible preference shares. Next is deferred shares. These shares were earlier known as, and it is issued to promoters or founders for the services which they have rendered to the company. These shares were known as founder shares because they were normally issued to the founders. These shares ranked last so far as the payment of dividend and the return of capital is concerned. Preference shares and equity shares have the priority as to the payment of dividend. These shares were generally of a small denomination, and the management of the company remained in their hands by virtue of their voting rights. These shareholders tried to manage the company with efficiency and economy because they got dividend only at the last. Now, these cannot be issued, these are only of historical importance. According to Companies Act 1956, no public listed company or which is subsidiary of public company can issue the deferred shares. Next category is no par stock shares. No par stock means shares having no face value. The capital of a company issuing such shares is divided into number of specified shares without any specific denominations. The share certificate of the company simplifies the states the number of shares held by its owner without mentioning any face value. The value of shares can be determined by dividing the real net worth of the company with total number of shares of the company. Dividend on such share is paid per share, not as a percentage of fixed nominal value of shares. The issue of no par stock offers a number of advantages, like it enables a company to present the balance sheet depicting its true and correct position. There is no need to reconstruct the balance sheet by way of capital reduction. There is no need to manipulate or window dress the accounts. Marketing of shares becomes easier. It includes investors to study the financial position of the company to know the value of their holdings. Next category, shares with differential rights. Shares with differential right means shares issued with differential rights in accordance with the Section 86 of Companies Act. Section 86 of Act as amended by Companies Amendment Act 2000 provides that new issue of shares capital of a company limited by shares shall be of two kinds: equity share capital, preference share capital. Equity share capital with voting right and equity share capital with differential right as to dividend voting, otherwise in accordance with such rules and subject to such conditions as may be prescribed. And with preference shares, it must be noted that issue of shares with differential right as permitted by Company Act 2000 is connected with equity shares only, not the preference shares. Next category, sweat equity shares. So the term sweat equity shares means equity shares issued by a company to its employees or to its directors at a discount or for consideration other than cash, for providing the know-how or making available rights in the nature of intellectual property rights or value addition, whatever name called. The idea behind the issue of sweat equity is that an employee or director works best when he has a sense of belongingness and is amply rewarded. One of the ways of rewarding him is by offering such kind of shares. It is also called as sweet equity, as employees become happy on the issue of such shares. The purpose of sweat equity share is to ensure more loyalty participation of employees. Section 79A of Companies Act 1956 allow the companies to issue sweat equity shares subject to the some conditions. Number 1, sweat equity shares must be of a class of shares already issued by the company. The issue of sweat equity shares must be authorized by a special resolution passed by the company in general meeting. The resolution must specify the number of shares, current market price consideration, if any, and the class or classes of directors, employees to whom the sweat equity shares are to be issued. The sweat equity shares can be issued only 1 year after the company is entitled to commence its business. Next source of finance is debentures. So, a company may raise long term finances through the public borrowings. These loans are raised by the issue of debentures. So, a debenture is an acknowledgement of a debt. A debenture holder is a creditor of a company. A fixed rate of interest is paid on debenture. The interest on debenture is charged on the profits and loss account of the company. The debentures are generally given a floating charge over the asset. When the debentures are secured, they are paid on a priority basis in comparative to other creditors. So in debentures also we do have some types like simple unsecured debentures, secured debentures, bearer debentures, registered debentures, redeemable debentures, irredeemable debentures, convertible debentures, zero interest bonds, zero coupon bonds. So in that way, some classifications are there in debenture itself. Next source of finance we are having flowing back of profits. Flowing back of profits is also called as retained earnings. Flowing back of profits is a technique of financial management under which all the profits of a company are not distributed amongst the shareholders as dividend, but a part of profit is retained or reinvested in the company. This process of retaining the profit year after year and their usage in the business is called as flowing back of profits. It is actually an economical way which a company takes instead of distributing the entire earning by way of dividend. It can keep a certain percentage of it to be reintroduced into the business for its development. So, such a process is also called as self financing, internal financing, inter-financing. So, a part of the profit is flow back or re-employ into the business and is regarded as an ideal source of financing expansion. Modernization scheme as these is no there is no immediate pressure to pay a return on this portion of stockholders' equity. Under this method, a part of total profit is transferred to various reserves like general reserve, replacement funds, reserve fund, reserve for repairs, renewals. Sometimes secret reserve are also created without knowledge of the shareholder. From all the practices of financial management, this system of flowing back of profit is considered desirable as it helps in the financial and economic stabilization of the concern. So the need for flowing back of profits arise because of the sum of the purposes. The very first requirement of flowing back of the profit is for the replacement of old assets which have become obsolete, for the expansion and growth of business, for contributing toward the fixed as well as working capital needs of the company, for improving the efficiency of plant and equipment, for making the company self dependent of finances from outside sources, for redemption of loans and debentures. The last source of finance is which is depreciation, and depreciation is also regarded as a source of funds. Depreciation may be regarded as capital cost of asset allocated over the life of the asset. It means the gradual decrease in the value of an asset due to wear and tear, use and passage of time. In the real sense, depreciation is simply a book entry having the effect of reducing the book value of assets and the profits of current year for the same amount. It does not affect current assets or current liabilities and does not result in the flow of funds. So it is non-fund item. Hence, although depreciation is an operating cost, there is no actual outflow of cash, and so the amount of depreciation charged during the year is added back to the profit while finding funds from operation. So, but then is depreciation a source of fund? So there cannot be any definite answer in this, yes or no, to this question, as there is different of opinion on this point. But it can be said that with certainty that depreciation directly at least doesn't amount to a source of fund. However, under certain circumstances, depreciation helps a business concern to effect saving in payment of tax and dividend, amounts to withholding a part of the funds generated through normal trading operation. It is in this sense that depreciation can be regarded as indirect source of funds. However, it is not even an indirect source of funds under all circumstances. For example, a company is running into losses and there are no profits, then any amount of depreciation charged to profit and loss account will neither affect the tax liability nor any payment of dividend as there are no profits. In this case, depreciation doesn't amount to withholding of funds, hence it is not a source of fund at all. On the other hand, if the concern earns sufficient profits, then amount of depreciation charged to the profit and loss account will affect savings in the payment of tax as well as dividend and shall help in generation of funds. In case a concern earn huge profit, excessive depreciation then permitted under the Income Tax Act is charged to the profit and loss account. It shall result in generation of funds through saving in the payment of dividend. So I conclude it as it may be said that to the extent depreciation help in the effecting savings in the payment of tax and dividend, it may be regarded as a source of funds. So in this way, we have discussed many sources of the funds which a business can use and can raise the funds for the different investment opportunities. So all the sources of funds have their own advantages and the disadvantages. So firm can go with the internal financing also, self-financing also. There are many short-term loans and short-term financing is also available. In the short-term loans and the credit, the various sources of the finances are indigenous bankers, trade credit, installment credit, advances, account receivables credit, which is called as factoring also, accrued expenses, deferred income, commercial papers, commercial banks, public deposits. So all these are termed as short-term loans and advances, which can be used for the short-term period. All these sources of finances can also be categorized into three parts like short-term sources, medium-term sources, long-term sources. Under short-term sources, trade credit, factoring, commercial banks, installment credit, accruals, all these sources will come. Under medium term, issue of debentures, preference shares, bank loans, loan from the FIs, public deposits, all these comes under the medium term finance sources. Long-term finance sources can be the issue of shares, issue of debentures, flowing back of profits. So as I told you, all sources of finance have their own pros and cons. One can use any source of finance according to their requirement, according to the nature of the business, according to the nature of the investment opportunity. So with this video comes to an end. Hope this topic is clear to all and you all enjoy the video. Thank you.